Hey, yes, indeed, for accumulated other comprehensive income. And of course, that seems a little ambiguous. So let us see if we can break down AOCI and describe for you why this little section is in a financial statement and why it's in the equity section rather than, for instance, in a income statement. So what we're really looking at are these four categories, either the four most common items you're going to find in AOCI. Foreign currency translation adjustments, employee benefit plans, i.e. changes in gains and losses unrealized in pension accounts, gains and losses in marketable securities, we'll talk a little bit about what that really represents, as well as gains and losses on derivatives and hedge instruments. So let's take these one at a time. Foreign currency translation adjustments. Well, we've talked about this already a little bit, haven't we? Right? That if you have a company with foreign subsidiaries, the subsidiaries will typically do all of their business in the local currency in the country in which they do business. And therefore, many times you will have a fair amount of financial resources that have not yet been repatriated, and they are still in the other country. Now, as we've said before, those kinds of assets are then exposed to strengthening or weakening of the US dollar versus that particular foreign currency, which could result in increases or decreases in your expectations and therefore the level of your assets and liabilities. And what we're really talking about here is potentially substantial unrealized gains or losses. Okay? Now, when we say unrealized, you realize, I'm sorry, that's a pun. What we're really talking about is the difference between realized gains and unrealized gains. Let us see if we can paint this out for you. Let us say that you decide you are going to start collecting fine automobiles. And so it happens across your path, you're able to purchase perhaps a vintage mint 1956 Mercedes-Benz or something like that, a very valuable car, and you purchase it for $100,000, and then in a year, the price has doubled on the market value, right? It's now worth $200,000. If you do not choose to sell the car, you simply hang on to it, and you're proud that this investment has now doubled in value, at least in theory, right? If you don't actually exercise it, that's an unrealized gain. Have you experienced a gain on paper, but you just haven't actually executed on any of it? You're just going to hang on for another couple of years, right? It isn't until you actually sell and then the difference between your cost and the proceeds you receive, that's a realized gain. The reason I take this time to explain this is that everything in AOCI, they are all unrealized gains. None of these are realized, which is why they don't show up as affecting net income, right, in the income statement, because they are unrealized gains. The basic principle of AOCI is that these are significant enough movements in valuation that it needs to be reported, but it can't be reported as affecting net income because that would unnaturally skew the results, and as a result you couldn't really rely upon the net income number because all these other factors would be affecting it. So this is a sort of a intermediary solution. It is a holding tank for these items that really should be reported so that analysts are aware of them, but they haven't been realized yet. Okay, so returning to the slide, then you can also see why then with companies that have substantial investments in pension plans and perhaps substantial liabilities in pensions, the unrealized gains and losses on those instruments also would be reported in AOCI. So that's two of the categories. Here are the other two. Gains and losses on marketable securities. Okay, now this takes a little bit of explanation. What do we mean by a marketable security, and whose security? Well, what we're really talking about is a company that decides to invest and place some of its money into marketable securities, perhaps assets that they are not currently intending to use in operations, so they intend to invest and earn a return on it, right? So maybe they will pick up U.S. Treasury securities. Maybe they'll pick up corporate bonds from some other company. And if they are not going to hold them to maturity and they're not actively traded, then they are known as what is available for sale securities. These are debt instruments that the company has purchased as an investment. And as you can see there, if there is a difference between fair value and cost, those unrealized gains or losses are included in the AOCI statement. Okay, again, these are debt securities. If there are unrealized gains or losses on equity securities, that's not part of AOCI. Okay. Finally, if you have substantial unrealized gains or losses on certain derivatives that you're using to hedge exposures to, say, interest rates or foreign exchange rates or commodity price risks, those unrealized gains or losses are also included in AOCI. Perhaps one of the best known examples of a company leveraging hedging against their commodity prices is Southwest Airlines, that for a long time had used hedges as an offset for their jet fuel purchases in an environment of constantly rising jet fuel prices, right? And that was one of the factors that led to their real growth and financial stability during a period when many other domestic airlines were declaring bankruptcy. Right? And so one of the reasons why it continues to this day that Southwest is a financially healthy airline compared to others, that's a big part of the equation there. All right, you can see here J&J's AOCI reconciliation from the beginning to the end. You can see those four categories: foreign currency translation, gain or loss on securities. That, of course, refers to available for sale marketable securities, pensions, employee benefit plans, and derivatives and hedges. You can see what has been going on there. And it's typical for many companies. AOCI has become more negative over the past few years for a couple of large reasons. One is employee benefit plans, and the other is the U.S. dollar strengthening and therefore taking the hit in the foreign currency translation during that period of time. So what are we really saying here? When we talk about this other comprehensive income, it is that during any typical year that market values of the items included in AOCI will inevitably change one way or the other. And therefore, so do the unrealized gains and losses. And the changes in these gains or losses don't flow to the income statement because they're not really a part of net income. They haven't been realized yet. Instead, we need to aggregate them and label them as other so that, for the sake of disclosure, analysts know what is going on in the larger world, realizing that not everything that happens to a company is directly reflected in net income. And you can see there this graphic of how this works itself out, right? The relationship between net income and retained earnings and this AOCI section of comprehensive income. All right, some notes to take away from this. Accumulated other comprehensive income is, in a sense, an effort to capture market volatility that doesn't show up as net income, which is a reminder that just working purely off the income statement and just working through the implications of net income, as we've talked about in a prior module, may not always tell the whole story, because some companies will be exposed to a fair amount of global and macro risks. And therefore, you can look at AOCI as sort of a barometer of global exposure for multinationals, right? And finally, you're seeing that when we look at AOCI, we're really talking about possibly an impact on equity without necessarily a present correlating cash flow. And this can be a bit of a disconnect because a weaker appearance, a lower equity base that's been affected by AOCI, right? Even though the operating cash flow hasn't changed, it's really a healthier company than perhaps the equity base might tend to suggest. So that is a very quick examination of AOCI, Accumulated Other Comprehensive Income. Well, that's a mouthful. And we will see you in the last video of this module.